Welcome to Burns Hustles, where we turn side hustles into cash. Have you ever wondered how world events affect your investments? It's an intriguing question, wouldn't you say? It's also a complex one. The relationship between world events and investments goes beyond a simple cause and effect. It's an intricate dance with numerous players and variables. To understand the impact of world events on investments, we first need to recognize the types of events that can sway the markets. We're talking geopolitical changes, economic shifts, and major news events. These can all send ripples through the global economy, influencing investment values and decisions. Geopolitical changes, such as elections or conflicts, can shake investor confidence and shift market trends. Economic shifts, like inflation or changes in interest rates, can also have a profound effect. And we can't forget about major news events. These can send shockwaves through markets and drastically alter investment landscapes. So let's delve deeper into the world of investments and see how they are influenced by various global events. Remember the 2008 financial crisis? Let's take a look at how this world event impacted investments. In the year 2008, the world experienced a financial crisis of a magnitude not seen since the Great Depression. It all began in the United States when the collapse of the subprime mortgage market led to the bankruptcy of Lehman Brothers, one of the world's largest investment banks. The shockwaves of this event reverberated across the globe, leading to a full-blown international banking crisis. Investments, as you can imagine, took a significant hit. The stock market plummeted, with the Dow Jones Industrial Average losing more than half its value. Investors witnessed their portfolios shrink dramatically and in some cases vanish entirely. Real estate, once considered a safe and stable investment, also suffered as the housing bubble burst. Property values dropped, leaving many homeowners underwater on their mortgages. But it wasn't just stocks and real estate. The crisis affected investments across all sectors. Commodities, bonds, mutual funds, no asset class was immune. Some sectors, like finance and real estate, were hit harder than others. But even those deemed safe havens felt the effects. Gold, often considered a refuge in times of economic turmoil, also experienced volatility. The 2008 financial crisis serves as a stark reminder of how interconnected the world's economies are, and how events in one part of the world can have far-reaching implications. It also underscores the importance of diversification in investment strategies. By spreading investments across a variety of asset classes and geographical locations, investors can better insulate themselves from the impacts of such events. As we can see, world events like the 2008 financial crisis can have a profound impact on investments. But by understanding the nature of these events and their potential effects, we can make more informed investment decisions and better navigate the ever-changing financial landscape. Fast forward to 2020, the COVID-19 pandemic shook the world and its economy. But what did this mean for investors? As the virus spread like wildfire across the globe, governments implemented lockdowns and travel bans. The world economy ground to a halt, and the impact on investments was immediate and profound. Let's delve into this a bit further. For some sectors, the pandemic created an environment of uncertainty and financial hardship. Travel and hospitality industries, for example, were hit hard. Airlines were grounded, hotels were vacant, and restaurants were shuttered. The sudden drop in demand for these services led to a significant decline in their market performance. Investors in these sectors saw their portfolio values plummet. But it wasn't all doom and gloom. Some sectors thrived amidst the chaos. Technology and healthcare in particular saw a boom. As people around the world were confined to their homes, the demand for digital services skyrocketed. Companies offering remote working solutions, online entertainment, and e-commerce platforms experienced unprecedented growth. Investors in these sectors saw their investments flourish. Similarly, the healthcare sector saw a surge. Pharmaceutical companies, biotech firms, and healthcare providers were thrust into the spotlight as they raced to develop treatments and vaccines. Investors who had stakes in these sectors reaped the benefits of this increased demand. The COVID-19 pandemic, like all significant world events, created winners and losers in the investment world. It underlined the importance of diversification, as investments in different sectors performed differently under the same global event. It also highlighted the importance of adaptability. Companies that were able to pivot and adapt to the new norm were the ones that survived and thrived. The pandemic has taught investors that world events can significantly impact market dynamics. It has shown that understanding these events, anticipating their effects, and adapting investment strategies accordingly is crucial. The COVID-19 pandemic serves as a reminder of the volatility of investments in the face of world events. So how can investors navigate through these world events, you might ask? The answer lies in the power of market analysis. Market analysis is the compass that guides investors through the tumultuous seas of the financial world. It's not just about observing the current state of the market, but also about understanding the underlying factors that can sway the market in a particular direction. One of the key components of market analysis is the understanding of economic indicators. These are statistical measurements that reflect the overall health of the economy. When economic indicators are positive, it often translates to a bullish market where investment opportunities abound. Conversely, when these indicators are negative, it could signal a bearish market where caution is advised. Interest rates also play a pivotal role in market analysis. Central banks use interest rates as a lever to control inflation and stabilize the economy. When interest rates are high, borrowing becomes expensive, and this can dampen business activities, which may negatively impact the stock market. On the other hand, when interest rates are low, borrowing becomes cheaper, potentially stimulating economic growth and positive market performance. And let's not forget about inflation, the silent thief that erodes the purchasing power of money. When inflation is high, the cost of goods and services increases, and this can impact consumer spending and business profitability, ultimately affecting the stock market. By keeping an eye on inflation rates, investors can anticipate these potential impacts and make informed investment decisions. In essence, market analysis is about connecting the dots between these various factors to anticipate market trends. By understanding how these factors interplay, investors can make informed decisions about when to buy, when to sell, and when to hold their investments. This process isn't foolproof, of course. The financial markets are influenced by a myriad of factors, some of which are unpredictable. But with diligent market analysis, investors can at least be better prepared for whatever the market might throw their way. Market analysis is a crucial tool for investors to navigate the unpredictable tides of world events. World events and investments are intertwined in a complex dance. As we've explored, significant occurrences like the 2008 financial crisis or the COVID-19 pandemic can cause seismic shifts in the investment landscape. These instances demonstrated how economic turmoil driven by world events can dramatically impact the value of investments. Understanding these interconnections is crucial. It's not about predicting every global event, that would be impossible. It's about being aware of the potential ripple effects they can have on markets and investments. This is where market analysis steps into the spotlight. It helps us navigate these complex waters, providing insights into economic trends, interest rates, and inflation, among others. In conclusion, the interplay between world events and investments is intricate and ever-changing. Being aware of world events and conducting thorough market analysis can help you make informed decisions and potentially safeguard your investments in times of uncertainty.